So we're here in Westport, Connecticut today with the one and only Peter Schiff. Peter, welcome to Real Vision.
Well, thanks for having me on Real Vision. My pleasure to be here.
Now, most people that are even casually familiar with the gold world have either come across you or have heard of you, but for the few who haven't, if you could just give a quick little intro of who you are and what you do, that'd be great.
Sure. Well, in the gold world, I do have a gold company, Schiff Gold. We've been selling physical precious metals since about 2010. But prior to that, I was a dealer for the Perth Mint, and I have been and continue to sell precious metals to my stock investors at my broker-dealer, Euro Pacific Capital, which is also an asset management company. I run the asset management company out of Puerto Rico. The BD is still based here in Westport, Connecticut, and I've been running that company since I first started it out in Southern California back in the 1990s. And where I kind of rose to fame was in my forecasts of the 2008 financial crisis. I was a very vocal critic of the Greenspan policies during the 2000s. In fact, I was a critic in the 1990s of Greenspan and the policies that inflated the dot-com bubble. But when those same policies inflated a larger bubble in the housing market, I was a much more vocal critic of those policies, and it ended up with me writing a book called Crash Proof: How to Profit from the Coming Economic Collapse. That came out in 2007, became a New York Times bestseller, and I followed that up with several other bestsellers. And a lot of people began to know me from a lot of the television appearances that I made leading up to the 2008 financial crisis, when CNBC labeled me Dr. Doom and everybody was laughing at me. Of course, when everything that I predicted came to pass, all of a sudden I had a much harder time getting invited on these television shows. So I'm not as frequent a guest now as I used to be. I used to be on pretty much every week. In fact, I was on so much that I have my own studio. I have one here in Connecticut. I have a studio in Puerto Rico. But now it's kind of rare that I get invited on. In fact, I do more television outside the United States than I do inside.
Yeah, and I remember after the 2008 and 2009 kind of crisis hit and came to be true, there was the viral "Peter Schiff was right" YouTube video that went around for a long time.
Yeah, someone put that together and they kind of made a montage of a few of my appearances in 06 and 07 when so many people were mocking me and laughing at me. Most of it was on Fox News, and also some CNBC clips. And over 2 million people originally saw that. And so that really helped raise my profile. A lot of people didn't know who I was, saw that video, then started snooping around on the internet. And then I ended up getting drafted into a Senate campaign here in Connecticut. I unsuccessfully tried to get the Republican nomination in 2010. I lost to Linda McMahon, who lost to Dick Blumenthal. Then she ran again 2 years later and lost to Murphy. So she lost twice, but she spent about $100 million on those two Senate campaigns. $50 million the first time, and $30 million of it was in the primary. So I only spent $3 million. So she outspent me, 10-1, and that was the problem. She only got twice as many votes as I did, but she also got a lot more immediate attention than I got. So I did that, and when I didn't win the Senate seat, I did do a syndicated radio show for about 3 years. I did it every day for 2 hours, which was pretty difficult, given all the other demands on my time. But I managed to squeeze that show in. But after a few years, I realized that I just didn't have the time to commit to it. And since it really didn't take off, it was syndicated, it was on stations, but none of the really big stations were carrying it. Probably more people were listening on the internet, maybe even than on conventional radio. I gave it up, but I still produce or do a podcast, which is, do a couple of episodes a week. People can listen to it on schiffradio.com. They can listen anywhere, iTunes, anywhere that there are podcasts, and I post them on my YouTube channel. So I still get a lot of people following me. I just don't do the daily talk show.
Now, you touched on a couple of things that I definitely want to follow up on. First is, the whole CNBC appearances and the fact that you used to be on a lot and then now you're not. I've found in the gold world, if you say something, let's call it what they think is outrageous. If you say gold's going to go to $2,000 or $5,000 or $10,000, whatever the number is, they kind of think it's outrageous. Now, I kind of personally believe that it's outrageous that people don't think gold's going to go to $2,000. But be that as it may, the mainstream media thinks when somebody says like that they're kind of crazy or something. But do you even care how they perceive you, or do you enjoy kind of the back and forth? Do you enjoy kind of being the villain, so to speak?
Yeah, the one time that people started agreeing with me on gold, was right near the peak when it was near like 1900, which made me a little nervous. And in hindsight, yeah, I should have sold and bought everything back because all of a sudden people started believing me. But, it's not just CNBC. I used to be on Bloomberg almost every week in 06, 07. They used to have me guest host some of their shows. I'd be on for the entire hour. I haven't been on Bloomberg in 8, 9 years. In fact, anytime somebody books me, whenever there's a producer that books me, they end up canceling the hit before I get on, because there's some rule there that I'm not allowed on the network, but not all the producers know about it, especially the new hires. And so they don't get booked. But my appearances are way down. I'm hardly ever on Fox. I used to be on CNN a lot. When I was very critical of George Bush, CNN liked to have me on. But during the 8 years of Obama, they never had me on. And so there's some other shows I did here and there, MSNBC and, seeing the headline news. But a lot of these stations basically backed away from me. CNBC rarely has me on anymore. Every few months, maybe I go on. Sometimes I go on their internet. They let me on the internet, but not on their actual air, which maybe is one of the reasons why their ratings are so bad. If they had me on more often, they might have more people tuning in. I think more people listen to my podcast than watch their network. But I'm not really sure why the mainstream has really backed away from me when for a while they had me on a lot. And maybe it was just I was a novelty. I was like comic relief, and it let them show, oh, well, look, we have the other side.
Yeah.
But I think once I got a lot more credibility, having been right and having made so many people on air look foolish, because I think a lot of people are afraid of having me on because they know that one day they could be in another Peter Schiff was right video. And a lot of people were upset being in the last one, because they looked pretty bad. But I don't really need the media as much. I mean, when people didn't know who I was, they heard about me. But I have a big enough following on my own now that if I have something to say, I don't need television to say it. I can say it, on the internet, on YouTube, and I have enough people who are going to hear what I have to say.
Well, now let's change gears a little bit and let's touch back on the politics that you mentioned. The Senate run in 2010. I don't want to put words in your mouth, but I think for the most part you lean libertarian. Have you always been that way, or was that something that developed over time, or were you raised in a house that was libertarian?
Yeah, well, my father was very free market oriented, hard money, libertarian, Ayn Rand type of guy. He was a big Goldwater Republican back when most Republicans were Rockefeller. And of course, he's Jewish, very few Jewish Republicans at all. So I was raised, in a way to understand the proper role of government and to understand free markets and why they work and why socialism doesn't. So I've always kind of known this. I didn't have to come to these ideas on my own. I really respect a lot of people who, are raised, with Democrats. My father's parents, my grandparents were big Roosevelt Democrats. So my dad didn't have the benefit that I did. His father was pretty much a socialist, like all the other Jews in his neighborhood where he grew up in Haven, right? They believed in government, even though my grandfather was a self-employed carpenter and should have been a fan of limited government. It's philosophically, a lot of people, believed in government. So my dad had to come to these realizations on his own. He didn't learn it in school. His professors were teaching Keynesianism, right? So he had to go out and learn about Austrian economics by himself. I at least was pointed in that direction by my dad. And I know there are a lot of other people too that have had a much harder road to travel to get to where they are. I had an easy road because I was put on the right path from when I was a kid. My dad used to tell us stories about economics in the car. In fact, one of the books that I wrote with my brother, How an Economy Grows and Why It Crashes, was based on a story that my dad wrote, but used to tell us when we were little kids before he put it into a book himself. So, I've always had these ideas.
Got it. Well, I think that's one of the reasons why I like either reading the stuff you put out or watching your interviews, is because regardless of whether I agree with what you say or not, it's always based in sound fundamental analysis. And you not only have the Austrian side, but you understand the Keynesian side. You maybe don't agree with it, but at least you understand where they're coming from and you can show where it's wrong. And it's not just, somebody preaching from a mountaintop that, stocks are going to crash or gold's going to go to 10,000. It really is based in real economic thought.
Yeah, I mean, Keynesianism is based on emotion. It's based on feelings. It's based on doing what sounds right and making yourself feel good. You can feel better about yourself if you support all sorts of government programs without actually understanding the effect of the programs, that they actually backfire and they achieve the opposite of what their intended goal is. But liberals don't think these things out, right? They think with their hearts, and they ignore all the anecdotal evidence that shows that what they believe is wrong, because they're very closed-minded. And then they believe that people like myself or conservatives or libertarians that don't support these programs, they just believe they're bad people, that they're mean or they're evil. And they don't understand that it's just their own naivete. The people that don't support these programs don't do it out of meanness. It's because they actually understand the unintended consequences that the liberals ignore.
Yeah, so, I would agree with that. It seems like most people judge a new policy on its intentions rather than its results, right?
Yep. And what they say about intentions and the road to hell.
Right.
And the left has laid a lot of asphalt over the years on that road.
Well, this kind of leads into another question. You're the perfect person to ask this for, is being such a free market thinker and understanding the fallacies of the Keynesian side of it, or at least as you perceive the Keynesian side of it. Does it make it easier to manage money, or does it make it harder to manage money?
Well, it certainly makes it more frustrating at times because, if you're a long-term guy, and that's what you have to be to allow these cycles to play out, in the short run, it can be very difficult because you're going against the herd. I mean, in the short run, it's not who's right, that makes money. It's just who's got the numbers, right? In the long run, it's the markets are a weighing machine, but in the short run, they're a voting machine. And if more people are fooled by government policy and Fed policy, and they're doing one thing and you're doing the opposite because you understand the long-term effect of these policies, it can make it hard because you could be wrong for a long time on paper before you're proven right. And a lot of investors don't have the fortitude, don't have the long-term time horizon to ride it out. I mean, I've got the same thing going on now with a lot of my clients who, have been closing accounts with me to invest in the U.S. stock market, which I think is a crazy thing to be doing, especially since, we've outperformed the U.S. market for all of 27 and all of 2017 and all of 2016. But over the last 5 years, we haven't done that. And that's because from 2013 through the end of 2015, not only did you have a U.S. stock market bubble, but you had a dollar bubble. And so that suppressed returns on overseas investments, on commodity-related investments, emerging markets, on gold. And so over that time, 5-year period, yes, people would have been better off investing in the U.S. market than investing abroad with me. But the game isn't over.
Right.
The U.S. stock market is a bubble that's in search of a pin, and it should have popped a while ago. The dollar is an even bigger bubble. And people that understand this understand how much money is going to be made by taking the other side of this trade. When the air comes out of this bubble, when the dollar reverses and surrenders all these ill-gotten gains, and in fact, it's going to move to all-time record lows, and when the U.S. stock market starts to turn lower as foreign markets decouple and move higher, then all of a sudden the people who have understood the error of these policies are going to get paid, and they're going to get paid in a big way. Just like we got paid for shorting the subprime mortgage market. I mean, that trade took years to play out. I mean, I was warning about the housing bubble since the Fed first started inflating it in 2002. I started writing my book about the housing bubble in 2005. In fact, the original title of my book, Crash Proof, it was going to be all about the housing bubble and, the coming American nightmare. But I ended up just condensing the housing part into a chapter and writing a broader book. But I saw this bubble from a mile away, yet it wasn't until 2007 that the air came out, right? So you had to be patient. And even forgetting about shorting the subprime market, I was just, as an individual, I was renting homes for years because I refused to buy because I thought the market was so overpriced. And people used to make fun of me. But, the house that we're in now, I mean, I eventually bought it. But of course, I'd be better off if I was still renting it. But, when I did finally buy it, I bought it for half of what the guy who sold it to me paid for it when he bought it, in 2002. And in the meantime, it was for sale for a long time before I bought it. I bought it for probably 70% lower than the original offer price. But all the time that I was renting, people kept saying, hey, you're throwing away money on rent. I was saving money by paying rent because I didn't overpay for the house. But in the short run, housing prices were going up. Like the guy who sold me this house on paper thought he was making a lot of money until he finally had to sell the house at a loss.
Right.
But for a while, right, he thought he had a lot of profit in the house because that's what the realtors were telling him. That's what the supposed market value was telling him. But of course, it was all on paper because he didn't sell. And so right now you have a lot of people that are in the U.S. stock market that think they have a lot of profits. They don't have anything. They haven't sold. They have the opportunity to make a profit, but they may not. And, you know, the Fed has actually blown 3 enormous bubbles, right, during this cycle. They blew up a bubble in the 1990s. When that one popped, the market lost half its value. Then they blew up another bubble. That popped in 2008. The market lost half its value. Now the Fed has blown a third bubble, right? This is the biggest one yet. Now, if it just repeats what the last one did, it's going to lose half its value again. Now, we're at, what, 22,000 right now. That means 11,000. But even if the Dow goes to 30,000 rather, and loses half its value, that's 15,000. That's still well below where we are now. But the risk is, what if the Fed can't come to the rescue again with an even bigger bubble? What if the third time's not the charm, right? What if it's 3 strikes, you're out, right? People think, oh, you know, the Fed's going to make it a hat trick. No, I think there's a good chance that the next time the market goes down, it goes down for the count. Because I don't know that there's a bigger bubble the Fed could blow. This could be it. This could be the last bubble they ever blow because it's the biggest one yet. And when the air comes out, I don't think there's any way to reflate another one. The only thing they can do is completely destroy the dollar. And if they succeed in doing that, which means they create a currency crisis and a sovereign debt crisis, I mean, a crisis in the treasury market, not in the mortgage market, that's going to lead to something much worse than a financial crisis. But if they don't do that, because they don't want the dollar to, become monopoly money, then we're going to have a much worse financial crisis than the one we had in 2008.
So you brought up the Fed. It's a perfect intro to this question I try to ask everybody who's got a firm understanding of economics and central banking. The Fed. Are central bankers morons who really mean it or idiots who are just putting us on?
Well, I don't think they're either idiots or morons. I mean, the question is, do they actually understand economics? Because there are a lot of very smart people who have high IQs, right, who know nothing when it comes to economics. I mean, they think they know something. The problem is they don't know anything. They don't realize how little they know. They studied so much Keynesianism that all their common sense, went out the window, and they've basically been indoctrinated or brainwashed, and it's impossible for them to see the truth. Now, I know Alan Greenspan, who kind of started this, right, after he took over from Volcker, who was really the last decent Fed chairman we had. Greenspan had a lot of potential because he was a real free market guy, a gold bug, an Ayn Rand, libertarian, and he still is. But for some reason, when he became the Fed chairman and he became the maestro and he was everybody's favorite guy and he wanted to be liked and he got corrupted by the power, he played the game and he went along trying to artificially prop up the markets to stimulate the economy, to help out the incumbent politicians, to help out the bankers, and he basically sold his soul. And once he left, and he's not Fed chairman. If you hear him talk now, yes, he's talking about, we're headed for stagflation, we got some problems. Of course, doesn't want to acknowledge or accept responsibility for his share because he really wrote the playbook that Bernanke followed and that Yellen is following, and they just took it to an extreme that maybe Greenspan himself never would have gone to, right? He might have not, gone this far, who knows? But I don't know if Bernanke, and I've had a chance to talk to Bernanke a little bit. I've never spoken with Yellen, but from the brief conversation I had with Bernanke, the guy seems pretty clueless to me. I think he genuinely believes that he did the right thing and that everything is fine. I mean, which of course is the opposite. I mean, I think Greenspan understands the mistakes that he made. He just doesn't want to acknowledge it publicly, and he doesn't want to throw, the current Fed chairman under the bus. He wants, so he doesn't want to be critical. Maybe because there's also an expression, when you live in a glass house, you shouldn't throw stones. So it's hard for him to criticize Yellen because look what he did. But I think he understands that what he did was wrong, and that Bernanke and Yellen have made big mistakes, and that the U.S. is in a lot of trouble, and we're heading for disaster. I don't think Bernanke or Yellen understand that. Now, I could be wrong, right? But you always have to figure out, are these guys just ignorant or are they lying? Because I remember there was an interview that I listened to on the radio with Ben Bernanke a few years ago. And the guy that was interviewing him, I don't remember who it was, but he played him a clip of some interviews that he gave in 2005 or 06, in which Bernanke was very sanguine about the economy, downplayed the risks of the housing market. There's no bubble. Everything is fine. Nothing to worry about. All the naysayers are wrong, right? Completely the worst thing you could have said, right? Completely wrong right before the collapse. And so the interviewer says to Bernanke, how do you feel now listening to that? I mean, knowing how wrong you were, how do you feel today, hearing that? And then Bernanke's answer was not, I really screwed that one up. He basically said, in all fairness, I couldn't really speak my mind because I was a member of the administration. So in other words, he's basically saying, just because I said everything was okay doesn't mean I thought everything was okay, because I had to talk the administration's line, which is everything is great, which of course he's not a member of the administration. That's the central bankers are supposed to be independent. The problem is they don't act independent. They act as if they're part of whatever administration happens to be in the White House. So if Ben Bernanke fancies himself a member of the Bush administration and George Bush is talking about how great the economy is, then Bernanke doesn't want to contradict that narrative. So he basically said, I wasn't being honest. Now, maybe he was being honest. Maybe he's lying now because he's embarrassed about being so wrong. So he's pretending that he just, had to cover up his true feelings. But we don't know. Was he lying then or is he lying now? And is Janet Yellen, is she lying? Look, for years she was talking about, raising interest rates, yet she only really raised interest rates once when Obama was president. I mean, the second time didn't count because he was, Trump had already won. Yeah. The second rate hike came when Obama was gone. And she didn't have to worry about the ramifications for Hillary Clinton because she wasn't going to be president. It wasn't until Trump became president that the Fed really started raising rates. But meanwhile, they kept talking about it, but yet they didn't do it. So to me, that showed that maybe the Fed realized that the economy was much weaker than what they were publicly claiming. That's why they were so reluctant to pull the trigger. But maybe once Obama, when Trump was in office and they saw, hey, we can blame it all on him, we can claim everything was great and Trump screwed it all up, then all of a sudden maybe they had the courage to raise rates because they thought they had a fall guy.
Well, it's interesting, about a year ago, maybe 2 years ago now, Greenspan was at a conference and they asked him, something regarding central bank independence. And his answer was, I never said the Fed was independent.
Yeah, well, as I said, they're supposed to be. In fact, that's one of the reasons that they object to all the congressional efforts to audit the Fed. They say, but if you audit us, we'll lose our independence. They're not independent now. Right. So we might as well audit them so at least we know what's going on. But yes, they should be independent. They shouldn't be subsidizing government. They shouldn't be having meetings with the Department of the Treasury and with the president and coordinating their efforts, because this is what is enabling all these deficits. I mean, Alan Greenspan, his entire life has been a big critic of deficit spending and the national debt and runaway entitlements. Well, the reason that all this is happening is because of the Fed. The Fed has cooperated by keeping interest rates artificially low and by monetizing so much of this debt. If the Federal Reserve did not do that, if they allowed interest rates to rise, the government would have had to stop the borrowing because they couldn't have afforded it. So it's the Fed that has enabled all this debt. So it's very hypocritical for Greenspan to rail against the debt and then having enabled it himself. And he kept saying, well, if they want to borrow, we have to make it easy for them. No, they don't. They could have forced a crisis because our politicians are never going to do the right thing unless there's a crisis. So as long as the Fed gives them an easy way out, they're going to take it. And, that's what Yellen's doing right now. I mean, interest rates are still near zero. Yeah, they're about 1%, 1.25%, but that's practically zero. Yeah. And, we have 20 trillion plus in funded debt, right? That doesn't even count all the unfunded liabilities, but that debt needs to be serviced and it's all financed with T-bills. And the only reason that we can pretend that we can afford to pay the interest on the debt is because the interest is so low. If interest rates were ever allowed to normalize, the United States would be Puerto Rico. There's no way that we could pay the interest on that debt if we had to pay a historically normal rate of interest on what is a very abnormal amount of debt.
I love all the points you just made, but it's a great intro to a little piece of devil's advocate I'd like to play with you here. You've mentioned that the stock market valuations are at extremes, due for a big fall. Same thing with the dollar. So are you owning gold for inflationary purposes or deflationary purposes? I have a tough time seeing how the stock market goes down 50 or 60% and the dollar goes to 70.
Yeah, well, it all depends on what the Fed does during that time. And, the stock market may not decline by 50%. I mean, the Fed can stop it if it prints enough money. Right? So, because what happens is instead of the market falling, the dollar falls. And if you're measuring the value of stocks in dollars, it's all relative. So if the dollar is losing value faster than stocks, stocks can go up in nominal terms, even as they're falling in real terms. So I own gold because of inflation, not because of deflation. It's because I don't believe that the central bankers have the guts or the integrity to allow the bubbles to deflate. I think they're going to continue to print money. I think they're going to sacrifice the dollar to prop up the stock market, to prop up the real estate market, to prop up the bond market. That's why we might not get another 50% correction in the stock market. Because again, if we do that, there's no way the Fed can reflate this bubble. There's no way that they can bail us out of the ensuing financial crisis. And because this bubble may literally be too big to pop, the Fed may be, try to keep as much air in it as possible. And of course, as soon as it looks like the economy is really turning down or the market starts to go down again, they slash rates and they launch QE4. And of course, since they're cutting rates from a very low level, there's not a lot of stimulus going from 1.25% to 0. They're going to really have to provide the stimulus through the quantitative easing, which really isn't a stimulus, it's a sedative. And I think it's going to be a lethal dose. I think we're going to overdose on the stimulus, and that's where the bottom really drops out of the dollar.
So the dollar's down 10% year to date, something like that. It had a big run in 2014, kind of leveled off for a while, then a big run the last 2 months of last year after the Trump election. But then, late January, early February, it turned down. The Trump euphoria kind of went by the wayside. And now the dollar went from like 103 on the DXY to, I think it's 92 today or 93.
Yeah, the dollar was, on its way to a collapse in 2008 before the financial crisis. Ironically, the financial crisis actually saved the dollar. Right? It bought the dollar a lot of time. It was at an all-time record low. Right? The dollar index was about 70. And the financial crisis came, and people didn't know how to react, and they all, bought dollars. But then once the Fed showed its cards with QE1 and what they were doing, the dollar started to fall. And it's my opinion that the dollar would have cracked and made a new low had it not been for the efforts of foreign central banks. If you remember, they called it currency wars, and all these other central banks kept printing money because they were panicking that the dollar was going to keep falling, and they were worried about their exports to the United States. So they print all this money, and that's what stopped the dollar from making a new low. But then the dollar caught a bid from the perception that all of a sudden everything worked. All the fears about hyperinflation, all the guys like Peter Schiff, we were all wrong. These guys are geniuses. They saved it. It's everything is perfect. Now they're going to unwind the balance sheet. They're going to normalize interest rates. And people started celebrating victory before it had been won. The Fed was taking credit for a battle they hadn't won. But all of a sudden, the market started looking forward. Oh, everything is great. The Fed's going to raise rates. And so the dollar started to rise, anticipating all these rate hikes. Plus, people were now worried about Europe. They were worried about China. We were the cleanest dirty shirt in the hamper. So we got this big run of the dollar. Then, when the Fed finally started raising rates in December of 2015, that's when the dollar peaked. That's when gold bottomed out, right? Buy the rumor, sell the fact, right? And then, of course, the fact never really lived up to the rumor because we haven't raised rates nearly as much as people thought they were. Right? And given all the talk about shrinking the balance sheet, so far it hasn't shrunk at all. So we never really had the fact to support the rumor that caused all the dollar buying. So the dollar kind of stopped going up. And then all of a sudden Trump won. And that kind of threw the currency markets for a loop because all of a sudden people started thinking, wait a minute, this is a game changer. After first being afraid of Trump, all of a sudden realizing, wait a minute, lower taxes, deregulation, this is good for the market. This is going to take the Fed away. We're going to have fiscal stimulus. This is going to mean higher rates, a stronger dollar. And the dollar made a new high, right? It took out the highs from 2015 and 16, and it started the year in 2017 at a new high. Dollar index almost got to 104. In fact, the most crowded trade in the U.S. was long the dollar and short everything else. Everybody was bullish. In fact, the most crowded trade a year earlier was short gold. For the first time ever, all the hedge funds were short gold right at the exact bottom, right? So they made the same mistake. Everybody came into this year long the dollar, and the dollar peaked around the second or third week of January, and it fell ever since. It rallied a little bit in September, again, on the renewed hopes for a tax cut. But I think this is, again, the same type of nonsense that rallied the dollar before. This is false optimism. I don't even know if we're going to get these tax cuts, certainly not in the form that they've been proposed. But whatever tax cuts we get, they are not going to produce economic growth, because this is not real tax reform. They don't have the guts for tax reform, because for tax reform, you actually have to raise taxes on certain people. You got to take away certain deductions. If you're going to have tax cuts, the only way to have real tax cuts is to cut government spending. But no one wants to do that. They want to say we're going to keep spending money. We're not going to cut anybody's benefits, but we're going to give everybody a tax cut. That doesn't work. All that's going to do is produce more inflation. So we're going to pay for the government through inflation rather than through taxation. And bigger budget deficits, more money printing is negative for the dollar, not positive for the dollar. So I think this, rally, this, tax cut inspired optimistic rally that we've had, in September, this is going to fade as well. I mean, I think the dollar could easily make new lows by the end of the year for this cycle. Or for this move. But ultimately, we are going to take out the low from 2008 in the dollar index. We're going to take it out in a big way. And I think the dollar is going to continue to fall in an orderly manner until it becomes disorderly, right? People are going to say it's a good thing, it's going to help our exports, until all of a sudden it's going to be a bad thing. Because now all of a sudden it's going to create a crisis of confidence in U.S. financial markets, and it's going to cause big increases in consumer prices, which are going to be impossible to mask beneath, the phony CPI statistics. So all of a sudden, you're going to start to see consumer prices really rising, the dollar tanking, yet the Fed stuck, at practically zero rates, because the only tool to fight inflation crashes the markets and crashes the economy. Because you live by cheap money, you die by it, right? Or live by QE, die by it. If we actually have to fight inflation, that's it. They've put us in a situation where it's impossible. The Fed has to surrender to inflation. Now, Volcker, I mentioned Volcker, he was able to raise interest rates to 20%. Can we do that today? Can we get anywhere close to 20%? We couldn't even get to 10%. We couldn't even raise rates to 5%, given the enormity of the debt we have and the way it's been financed, right? It's not financed with 30-year treasuries. It's financed with T-bills. So when interest rates go up, it doesn't just affect the money you're borrowing now. It affects all the money you've borrowed in the past, because you constantly have to roll it over at the higher market rate.
So you mentioned the most popular trade of 2015 was short gold. The most popular trade of 2016 was short dollar. But all of that's reversed now. If you look at the commitment of traders now, everybody's long the euro, everybody's short the dollar. So it's completely reversed. I have a hard time seeing, why is the Fed going to print when the market's already doing the work for them? If the dollar's dropping 20% annualized, they don't need to print.
Well, they're going to have to print, because they need to sustain these bubbles. And I think that budget deficits are going to get a lot bigger. Meanwhile, look at all these natural disasters we've had this year, the hurricanes, the fires. Where's all that money going to come from, right? A lot of disaster areas, a lot of FEMA bailout money, a lot of, people don't have insurance. And even the insurance companies, where does that money come from? If the insurance companies have to pay to rebuild houses, where do they get the money? They have to sell off some of their portfolio assets, so somebody has to buy that. And then, of course, they have to raise their insurance premiums, which is going to be another big negative for the economy, is going to be the higher cost of insurance. It's not just health insurance that's going to be more expensive. It's going to be property and casualty insurance, and all of that is going to, weigh heavily on the consumer. So, I think the Fed is going to be stepping it up. And yes, there are certainly a lot more people now that are long the euro than a year ago. There are some more people that are long gold now, but I would not say the trade is crowded. I think more people are probably agnostic about gold. than they are long. I don't see a lot of buying. The gold stocks, are barely up this year, even though the price of gold has gone up quite a bit. And that would show where the speculative money would be flowing into the miners, and it's not. I can tell you at my gold business, our sales are off about 80% this year from last year. So the public, because I sell gold to the American public, and they're not buying. And even at my own asset management company, this is the first year we've actually had net withdrawals from my managed accounts. Even though we have great performance, both absolute and relative to the S&P, people are taking money out because they want to invest in the U.S. stock market. So if you're looking at the retail investor, they're not buying gold and they're buying U.S. stocks. And my clients are Republicans. They're Trump voting Republicans who are now optimistic. I think incorrectly so. I think the optimism is wishful thinking. It's not, grounded in reality. But so I see the contrarian indicator the other way, right? People are not buying gold when they should be. They're buying U.S. stocks when they shouldn't be. And to the extent that some of the professional traders are bearish on the dollar, they're not nearly bearish enough. I mean, there are people who think the euro could go up a little bit. They have no idea how much higher it's going to go. And it's not just the euro, it's a lot of these other currencies. So I think a lot of the dollar bears are also wrong in that they're not bearish enough. They're just sort of bearish. They need to be super bearish. So if the bears can still be proven wrong if they're not bearish enough. And I think that's what's going to happen. I mean, the bulls are completely wrong, but even the bears are wrong.
So it's hard to argue with anybody that says, equities are not at a very high or historic valuations. Also, the dollar's been up. But why do you think it is that people don't focus on the high valuations of bonds? I mean, you almost never hear about the high valuation of bonds. A year ago, we had 17 trillion of negative yielding sovereign bonds. What happens if it just so happens to be that the bond market breaks first?
Yeah,
and the money comes flowing out of bonds. Where does it go?
Well, it won't necessarily go into stocks because
where does it go?
Well, it goes into gold and it can go into emerging markets or other commodities. Because remember, the only way you can justify the valuation in the stock market is based on interest rates. And that's what even the bulls will say when you talk about how expensive the stock market is. They'll say, yes, but relative to interest rates. That's the important thing. And so if the bond market collapses, that means interest rates are rising. That means stocks are even more overvalued because now you have to value them in a higher interest rate environment.
But don't they keep going up as the money flows out of bonds and it goes into commodities and gold and real estate? And isn't some of it going to go into equities?
Well, it depends on the stocks. They're oil stocks, natural, raw material stocks, basic materials, exporters, companies, multinationals that would benefit from a weak dollar. But it's not going to go into retailers. It's not going to go into the financials. I mean, so there are going to be certain segments of the market. Now, the way stocks benefit from inflation is to the extent that they do have debt, and a lot of U.S. companies have debt, and to the extent that it's long-term debt. Now, if it's short-term debt, it's not going to help them. But if you have companies that have borrowed and have sold 20 or 30-year bonds, and then there's lots of inflation, that's a transfer of wealth from the debtors to the equity holders. So companies will benefit from inflation in that they're basically not having to repay their debt. So the bondholders lose and the equity holders win. But when you have stocks that are at such high valuations, if they're at 25, 30, 35 times earnings, you have a lot of room for those PEs to come down. So if the PE comes down to 10 or 5, right? I mean, and of course, as interest rates rise, a lot of companies that have a lot of debt, that means their interest expense is going to go up. If they have short-term debt, that's going to put pressure on their earnings. And of course, if a lot of their companies or their customers rather have debt and now their interest rate costs go up, then they have less money to spend on their goods and services. So their revenues can be going down and their costs can be going up while their multiples are going down. So there's a lot of risk in the market. Also, a lot of people in America, older people, retired people, who got out of bonds because the yields weren't there, right? They couldn't live clipping those coupons. A lot of risk-adverse senior citizens are now loaded up on stocks. And so far, so good as long as the stocks are going up. But if these stocks really start to tank, and they start to see their nest egg evaporating, meanwhile, the dividends aren't there either, there's a lot of potential selling that can come there as people try to salvage what's left of their portfolio because so many people have just been conditioned to believe, well, stocks are not risky as long as you're a long-term investor. Well, if you overpay for them, they're very risky. I mean, stocks can be good investments if you get it at the right time. But if you overpay for them, or if you buy, near the peak of a bubble, it could be a disaster. Now, yes, the Fed, as I mentioned earlier, has been able to bail investors out of those mistakes the last 2 times. I would bet on it happening again. So there's a lot of risk there in U.S. stocks.
So let's assume that we air this video and a number of Fortune 500 CEOs, mid-cap size company CEOs watch this and they hear what you're saying and they say, wow, the dollar's going to go down a lot. Interest rates are going to go up. I better borrow while I can. I'll borrow now while the dollar, and as the dollar gets cheaper, I'll pay it off, right?
Well,
what if they do that and the $2.5 trillion that are in excess reserves at the Fed all of a sudden start to be levered up and loaned out to these medium-sized companies? Why wouldn't a CEO do that?
Well, the only CEOs that would lever up, you'd have to have the right income streams, right?
Yeah.
You'd have to have the right revenue sources to be able to service the debt. So if you're earning money internationally, if you're earning money on exports, obviously you're going to have extra revenue if the dollar is weak. So for that particular CEO, if he wanted to go out and borrow in dollars and issue longer term debt, hell, I mean, if you could issue a 100-year bond, do it, right?
Right.
And because eventually, in 100 years,
it'd be worthless.
Yeah, I mean, if you're mailing your check to your creditors, there's going to be a bigger number on the postage stamp than there's going to be on the check, right? So, so you could do that if you can lock in a really low rate for a really, really long period of time. But of course, most CEOs are not going to do that. I mean, they're in the business of running a company, not gambling on interest rates or currencies. But I would certainly, if I was a CEO and I was dependent on imports, this is going to be a big deal, because if you're counting on cheap imports coming in from abroad, and all of a sudden the dollar tanks and your imports are a lot more expensive, I mean, the people should be really hedging their currencies and hedging their entire businesses, because I think a lot of business models are going to fail once the dollar cracks, because a lot of U.S. businesses are based on the ability to sell inexpensive goods that have been imported to Americans who really don't have any money, have low-paying jobs, and generally have to borrow the money on their credit cards even to afford the cheap stuff that's being imported. But when the dollar tanks, not only will the cheap stuff become expensive, but I think the consumer credit market will also dry up. So not only will Americans have to pay double or triple for the stuff they want to buy at Walmart, but they're going to have to pay cash.
Yeah.
They're not going to be able to use their credit card. So, this is going to really change the landscape. And if people think that it's, a retail apocalypse now, they ain't seen nothing yet.
Let's say that it just so happens that bonds do start to crack first, maybe due to counterparty risk or whatever the reason is, global contagion. If and the dollar starts to really lose value, would you rather own bonds or stocks? Wouldn't you rather own stocks than the bonds?
Well, I mean, if those were my only choices, if it was U.S. stocks versus U.S. bonds, yes, I would take U.S. stocks. Now, I would not just buy the index.
Okay,
I would want to be selective and buy the companies that I think will do the best, and that will give you a better return than bonds. But the world isn't all U.S. stocks, U.S. bonds. Fortunately, I have other choices that are much better and that I'm making. But yeah, I've told people before, the bond bubble is bigger.
Yeah.
And no, there's no way you're going to win in bonds, right? Because either bond prices are going to collapse and you're going to have a huge loss if you sell your bonds, or you're going to have to clip a low coupon, for a long period of time, right, in order to avoid realizing that loss. Or there's going to be massive inflation that's going to wipe out the value of the bond. So one way or another, you're going to lose. Either you're not going to get your money back, or you're going to get your money back and it's not going to buy you very much. So I would rather be in stocks. But again, I'd rather not be in U.S. stocks either, because there are real serious problems for the U.S. economy that are not going to be friendly to the real value of stocks. And if you understand what's going to happen, there's going to be a major realignment of living standards and purchasing power. The American standard of living is going to fall sharply, and the value of U.S. dollar-based assets, whether it's stocks, whether it's real estate in America, are going to lose value relative to assets in other countries, right? And so what I want to do for my clients and for myself is own the assets that are going to gain in relative value and get rid of the ones that are going to lose value. Because America has been living beyond its means for a long time. And beyond our means, meaning we consume a lot more than we produce and we borrow a lot more than we save. And that's fun until the party ends. But the only reason that that's been possible is because other people in the world have been living beneath their means. They've been producing and not consuming. They've been saving and not borrowing. They've been doing the hard part. We've been doing the fun part, right? But I think when the air comes out of this bubble and you get this major realignment and transfer of wealth, Americans are going to have to suffer for their prior profligacy, we're going to have to roll up our sleeves and start working again and producing and saving. And I think other people in the world are going to start to reap the rewards of their frugality, of their underconsumption, of their savings and investment. And that's going to be in a higher exchange rate, which is going to enable foreign workers and foreign savers to consume more out of the global production, right? I mean, whatever's produced in the world is produced, and everybody bids for it. I mean, Americans have been able to grab a larger proportion that they're entitled based on the elevated value of the dollar. Well, when the dollar collapses, it doesn't do it in a vacuum. It means other currencies rise. Of course, all currencies can be falling relative to gold, but what's important as far as consumption is how the currencies do relative to one another. And as other currencies rise relative to the dollar, those consumers become richer, they consume more, and I think their assets are going to be more valuable. Real estate, stocks in other countries that are having appreciated currencies are going to be more valuable than real estate in the United States. So this is the major trend that people have to acknowledge is coming and make sure they're positioned to catch this wave, right? Not to get crushed by it.
So you and I, align ourselves pretty well on the long-term prospects for gold, maybe even the short-term prospects for gold, definitely the medium-term prospects for gold. And I think a big part of most people in the gold world argument is there's a finite amount of gold, but there's a lot of claims on it, but there's only so much physical gold that exists, right? But then there's the GLDs, there's the futures contracts that aren't really backed by gold, or you can't take delivery, the ETFs. So a lot of the argument is that when people scramble for gold, there's only so much actual physical that exists that'll push the price up a lot.
Yeah, it's
right?
going to go up. And of course, GLD, that is physical gold because the GLD, the ETF has to buy the actual gold in order to issue the shares. But yes, in the futures markets, there it's a whole different ballgame because there you have people selling gold who don't have it.
Right.
And people are buying gold that don't actually want it. They never intend to take delivery. So you can have this paper market of basically gambling on the price of gold. But yes, a lot of the demand that might otherwise go into real gold ends up going into futures contracts, which is not buying any actual gold. But where the problem is going to set in, and maybe it's not a problem if you're long gold, it's an opportunity or a good thing, right? But at some point, a lot of the owners of these futures contracts are actually going to request delivery. Yeah. Because just because they don't do it now doesn't mean they won't in the future. And at some point, the longs are going to want delivery and the shorts are going to get delivered a notice that says, yes, you need to deliver your gold. Now, the shorts don't have any gold. Yeah. So now they have to go into the market and actually buy it. Well, where are they going to get it? Right. And that's when you have a huge move up. And maybe even, a bankruptcy of the COMEX, or does it have to be bailed out, or, what's going to happen, or the people who are requesting their gold going to be told you can't have it. You're going to get paid in cash, even though you requested physical delivery, it's not going to happen. So this could be an explosion of real buying of gold. And, there are a lot of people that own gold that, it's all manipulated and all the, the paper markets are keeping it down. Maybe so, but it can't go on forever. Yeah. And for me, if they are manipulating it, that means the price of gold is artificially low. That means it's a great buy, right? We're going to get paid, right? When was the last time gold was really artificially low? It was when the government controlled the price until 1971. It was fixed at $35 an ounce. And then Nixon devalued a couple of times to about 42 before we went off the gold standard. But for years, the price of gold was artificially suppressed. But as soon as that stopped, gold went from, $40 to $850. Yeah. And so I think gold has been suppressed, whether it's an orchestrated plan to suppress it or just based on market forces of people just doing what they're doing. But you have a lot of activity that I think has suppressed the price of gold, but it won't go on forever. And eventually, market forces are going to overwhelm what's going on to keep the price of gold down, just like eventually overwhelmed the government's ability to keep the price down. And the price is going to find a real value. And it's going to be much, much higher than it is today, which is why people should own gold. Now, should they only own gold? No, I don't. I never tell people to only buy gold, but people should own gold. They should own some gold and they should own gold stocks. I mean, these things are dirt cheap. I mean, if you want to look at what stocks can do, look at what gold stocks did in the 1970s. I mean, there were stocks that went up 50, 100-fold. That's going to happen again. All right, so people just have to be in these stocks. Do you have to have your whole portfolio? No, but have some money in these stocks. Most people today have no money in gold and they have no money in gold stocks.
So using that same kind of analysis that we just applied to gold, that there's a limited amount of gold, but a lot of claims on it, and at some point when people call for delivery, it'll push the price up. If we do that same analysis on the dollar,
Mm-hmm.
there's only $4 trillion of base money. Everything else is loaned into existence. But we've got 50 or 60 trillion dollars of dollar-based debts in the world. That doesn't include the unfunded liabilities. That doesn't include the derivatives. So if we do get into a deflationary scenario before the inflationary scenario comes, the stock market starts to crash, and we start into another 2008 type event, doesn't that start a daisy chain of claims on the only $4 trillion that exists? And won't, for a short period of time, won't the dollar have those same kind of characteristics that we just talked about with gold?
Because dollars, A, intrinsically have no value, but B, can be created into existence by the Fed. They could create dollars whenever they want.
But they won't do it until it gets strong, right? If it's falling, why would they create more dollars?
Well, in order to prevent rates from rising and in order to bail out the government. So let's say we do have a deflation and rates start to rise, and the government has to default on the Treasury bonds. Is the Federal Reserve going to sit back and allow the U.S. Treasury to default on the Treasury bonds, or will the Federal Reserve bail them out by buying the bonds themselves, right? Because if the market doesn't want them at artificially low interest rates, and the Fed and the Treasury rather can't afford to pay higher rates, the only buyer is the Fed. Also, if the government has a choice, hey, we have these Social Security benefits that we need to pay, but we don't have any money. Where are we going to get this money? Oh, well, maybe we're going to default and tell the people who are expecting a Social Security check, you're not going to get your check. Or we have all these government workers who are retired, they're expecting a pension, we're out of money, we just got to tell them there's no check. Is the Federal Reserve going to sit back and allow all this to happen, or is the Federal Reserve going to create the money to make it all possible so that the politicians could pay what they owe? I think that's more likely than that they just apply, the tough love and say it's tough love and say, hey, too bad, you got a crisis, deal with it. Decide what, cut spending. I don't think that the Federal Reserve, our Federal Reserve, is going to do that. So gold, we know. If we run out of gold, it's gone, right? You have to mine it. It's hard to find. It's expensive to get it out of the ground, right? They can put as many zeros as they want, on those dollars. They can push buttons and create them in infinity. So it's not the same thing. We did have a run.
But leading up to it, until they push the button, when people are going to the banks and there's run on the ATMs and they can't get that cash in the 2 days, the week, the 2 weeks it takes to pass this bill doesn't the dollar go up?
Look, it went up in 2008.
Yeah, that's kind of what I was thinking.
But that's because it was at an all-time record low.
Okay.
Right. So it's not nearly an all-time record low now. It's not even close. And there's not a bunch of people short the dollar today like they were in 2008. And remember, back then, oil was $150 a barrel. Plus gold in 2008 had just gone from under 300 in 2001 to 1,000. So gold had just had 10 years in a row of going up and hit a record high. And then you had that. So we're not in that position now. We're not even close to that position. In fact, if you wanted to look at something that's similar, go back to 2000, 2001, because when we had the stock market bubble at that time, gold had been in a bear market for 20 years, right? The dollar index was 120 in 2000. And when the U.S. stock market bubble burst in 2001, the dollar went down, gold went up. So today we're similar to that circumstance and where the dollar and gold are trading, right? So right now we're going to get movements into gold and out of the dollar because of, just where everybody is aligned. But ultimately, if we get the type of crisis, I believe, where the Fed has to allow inflation to rage out of control, where they're forced to print money into a weakening economy, into a falling bond market, into an inflationary environment where gold prices are rising, where commodity prices are rising, that's the end game for the Fed. Because now everybody realizes the box the Fed is in. They can no longer pretend that they're going to be vigilant and fight inflation, because they'll obviously have surrendered to it, because they're going to choose to fight recession instead. They're going to choose to bail out the government rather than defend the dollar and protect its purchasing power. And then the game is over. Then there's a run. And then the Fed's going to lose control. And at that point, we're going to have to make a very difficult decision. The Fed's going to have to make a decision. It's going to be, okay, do we now raise interest rates dramatically, a la Paul Volcker, to save the dollar from collapsing into nothing, right? Which would be a complete disaster. But in order to do that, we're going to have to bring about a crisis on our own. which is going to be much worse than the '08 financial crisis, because all the big banks that we bailed out will fail again, except there's no bailouts next time. And it's not just going to be the shareholders of the banks that lose money, and it won't just be the bondholders, but the depositors. In order for the Fed to do the right thing, it has to let depositors of Bank of America, of Wells Fargo, lose their deposits because there is no money there. And the Fed cannot bail out the banks if it's also raising interest rates and shrinking its own balance sheet. So all the chickens have to come home to roost. The government has to fess up. We have to default on our bonds. We have to tell senior citizens, you're not getting Social Security, you're not getting Medicare. It's all over. These were promises we made to get your votes. We can never keep them. And, this is what you get for trusting us, right? John Belushi style, you effed up. Yeah. And just admit all that, or, they don't admit all that and the dollar does become monopoly money. And then, now we're, Zimbabwe.
Yeah.
But, we're going to have to choose our poison, right? I hope they make the right choice. But either way, the price of gold is going up. Just if they make the wrong choice, it's going to infinity, right? Because the dollar goes to zero.
Yep.
But hopefully that doesn't happen. I mean, I want to make money, but I don't want to make it that badly. I don't want the country to suffer to that extent. I know it's going to suffer, but I hope that, we take the right medicine so that we ultimately, can end the suffering and have a real recovery.
So, Peter, this has been fascinating. I knew you were the perfect guy to kind of wrap this dollars and gold story up with. You didn't disappoint. I really appreciate you taking the time. And I think we both agree that, you got to own some gold in your portfolio. Regardless of the way this ends, it's not going to be pretty.
Yeah. And, one way everybody should own gold, too, is through a company called Gold Money. Didn't get to bring this up, but, in addition to owning physical gold, which I sell through Schiff Gold, but Gold Money allows you to own gold in a way that you can use it in commerce. I mean, Gold Money is kind of like the PayPal for gold. It's a global payment system where you can earn and spend and save in actual gold, and you can use gold through an app on your cell phone, and you can use it in commerce. So I can buy a cup of coffee and pay for it in gold, or I can sell somebody a cup of coffee and they can pay me in gold, or I can buy a car, or I can buy a house. You can spend a small amount of gold or a large amount of gold. It's easy and free. You can send your gold anywhere around the world. And in fact, if you want to interact with the fiat world until everybody wants gold, you get a free debit card, and you can, any place that takes MasterCard or Visa, you can spend your gold using your debit card, because it allows individuals on their own to put themselves on the gold standard, to reject fiat money, to save in gold, earn and spend in gold, and get out of the banking system. And also, as I said earlier, there's a good chance that a lot of banks are going to fail. And if they don't get bailed out, you're going to get bailed in, right? You're going to lose money as your bank fails. But if you use Gold Money as your so-called bank, it's just as liquid as a checking account. You can access the money and spend it just as easily, except it's not in a bank. It's in a vault. It's in a Brinks vault. It's your gold. Nobody lends it out. So you can never lose it. I mean, yeah, the gold price can go down, but you can't lose your ounces. Whatever you have, you own. You can deposit money in a bank, you could lose it all. The bank can lend it out and never get it back, right? You're a creditor when you put money in a checking account. When you have a Gold Money account, you're not a creditor. They're holding the gold for you. You're an owner of that gold at all times. You're not loaning it to a bank that basically is insolvent and is only being propped up by the government. Of course, if the Federal Reserve stops all the banks from failing, it's only because they wipe out the dollar to inflation. Well, there again, if you have gold in your Gold Money account, you're immune to that inflation. So you're protected from bank failure, you're protected from inflation, because you can store your savings in gold, yet not give up the liquidity. So that's what a lot of people, the knock against gold was, well, yeah, but how do I spend my gold? I got to borrow gold. How do I spend it? Well, you can carry $100,000, $1 million worth of gold in your cell phone, in your wallet, on a debit card, and it's real gold, and you have access to it 24/7. So that solves the problem. Gold Money solves that problem. It makes gold as liquid as any fiat currency, except it's a reliable store of value. And you don't have to trust the government, and you don't have to trust the banks.
Fascinating, Peter. Thanks again. Look forward to seeing you next time, and I'll definitely be following you along the way.
Great. Absolutely.